Okay, so now we go to the lesser known provisions of Section 34, which you would consider as boring. Pang accountant ra mo gud ni. Uy. But okay, you notice this subparagraph 3 on subparagraph C, Charlie, Section 34. I think this was asked. Yeah, remember the boxer who played and won somewhere in the, I think it's in the US. You must know that the tax, before he can use the taxes he paid in foreign countries, he has to say, or the taxpayer has to signify in his income tax return his desire to have, the desire to have the benefits of this paragraph. And that's for, okay, this, it shall be credited with citizen and domestic corporation. You remember figure 1, the income or the sources of income from within and without the Philippines. So whenever they earn income, citizen and domestic corporation, wherever the income comes from, they would be taxed. But of course, if the income or they had income or they realized income somewhere in, say, in the US, then they would also be taxed there because they're considered as non-resident alien, right? And the taxes they pay there can be credited here. You just read this. There are rules here, or the procedure. And you notice here, an alien individual and foreign corporation shall not be allowed the credits against the tax for the taxes of foreign countries allowed under this paragraph. The reason is they are not taxed for the income they earn outside of the Philippines, okay? So you must have a good grasp of it. You just remember citizen and domestic corporation, resident citizens, are the ones who are taxed for income within and without the Philippines. There's a reason why they are not allowed to get tax credits for the taxes they pay in foreign countries. And you have these limitations, okay? The amount of credit taken under this section shall be subject to each of the following limitations. The amount of credit in respect to the tax paid or incurred to any country shall not exceed the same proportion of the tax against which such credit is taken, which the taxpayer's taxable income from sources within such country under this title bears to his entire taxable income for the same taxable year. So this just means that the tax credit should not exceed the tax here in the Philippines. It should never exceed for against which such credit is taken in proportion to the under this title bears to his entire taxable income for the same taxable year. And the total amount of the credit shall not exceed the same proportion of the tax against which such credit is taken, which the taxpayer's taxable income from sources within the Philippines taxable under this title bears to his entire taxable income for the same taxable year. So there are two scenarios here. It should not exceed the taxable or the tax against which such credit is taken in the country where the tax is paid and for the sources within the Philippines. So if your taxable income and you have this tax due, tax payable in the Philippines, the tax credit should not exceed that. That's the meaning of this. And you have this adjustment on payment of incurred taxes. You just read this. And this one, you have to establish the proof of credits. Okay? Shall be allowed only if the taxpayer establishes to the satisfaction of the commissioner the following. Okay, the total amount of income derived from sources within the Philippines, and this one, paragraph B and C. You may want to memorize this. This is the gist of it, and that's it for taxes. Okay, so this was asked, and you just understand this, and we now go to losses. Losses in general actually sustained it is allowed. You may claim for losses during the taxable year and not compensated for by insurance or other forms of indemnity. Okay, it is allowed as deductions. If it is incurred in trade, profession, or business, or property connected with a trade, business, or profession, if the loss arises from fires, storms, shipwreck, and other casualties, and from robbery, theft, or embezzlement. But remember, there's this, if it is not compensated for by insurance or other forms of indemnity. Okay? You just read this. The proof of loss. This one class, net operating loss carryover. The idea, I'm sorry for that. The idea of this provision is that you can carry over the loss for what? For 3 consecutive taxable years, immediately following the year of loss in which you sustain. So for every year, if you have like a 100,000 loss and you don't, there's this, you can carry that over. The net operating loss of the business or enterprise for any taxable year immediately preceding the current taxable year, which had not been previously offset as deduction from gross income, will be carried over as a deduction from gross income for the next 3 consecutive taxable years, immediately following the year of such loss. This is different from the MCIT carryover. That's the different, but well, that's, you would not be asked of, again to compute on the NOLCO and the MCIT carryover, minimum corporate income tax carryover. But the idea here is you can carry that over. You just read this. And for the capital losses, this one, you remember section 39, we'll go to that later. And this one, you can, securities becoming worthless. If securities as defined in section 22P become worthless during the taxable year and are capital assets, the loss resulting therefrom shall, for purposes of this title, be considered as loss from the sale or exchange on the last day of such taxable year of capital assets. Okay? Loss from sales of stocks, securities, it is wagering losses. Losses from wagering transactions shall be allowed only to the extent of the gain from such transactions. Wagering. Abandonment, you just read this. This is, I think, the abandoned well and re-entered and production resumed. My favorite. Bad debts, there is this, well, as I've mentioned, there is also this tax benefit rule and also bad debts. The BIR has a revenue memorandum circular here, class, on you are allowed to claim bad debts if you comply with the requirements, okay, are actually ascertained to be worthless and charged off with the taxable year, except those not connected with profession, trade, or business, and those sustained in transaction entered into by parties mentioned in section 36B. This one, if you loan money to your mother or your brother, the related parties, you cannot write it off because, well, siguro, well, the related parties, as mentioned, you don't even pay your mother or sister, and your mother may be okay, pangayon lang ako ni na, Merry Christmas. So, you're not allowed to bad debts, to recognize bad debts for that transaction. And there's this tax benefit rule. This is the tax benefit rule. You have to declare that or to include that as part of your gross income in the year of recovery. If you recover your bad debts, there's also these securities becoming worthless. And the depreciation under paragraph F, well, as I've said, you will not be required to compute the straight line method, the declining balance method, the sum of years digit method, and any other which may be prescribed by the Secretary of Finance. The idea here of depreciation is that whenever you buy like a capital outlay, okay, a machinery, you erected a building, you constructed, is a better word, constructed a building, and you estimate that the life of the building would be 20 years. So to get the depreciation, you just divide the cost by the estimated life, and you get that's straight line method. Okay, the easiest method to ascertain depreciation, and once you get the depreciation amount, then yearly you can claim for it. That is a non-cash depreciation or non-cash expense, as we term that in the accounting. Agreement to a useful life in which you just read this. Depreciation property used in petroleum operations. I'm guiding you now to be more extensively bored on the provisions. You just read this class. Depreciations of properties used in mining operation. Read that. Of course, you have to understand this. And depletion of gas and wells and mines. Okay, just browse through this, read this, and understand. You don't have to memorize that. Just remember there are just you can memorize on the this one, and you just understand the provisions, and you may be able to answer if well. Again, I would emphasize these are the lesser known provisions of Section 34. So you memorize this one up to I think this is up to I am that's up to M. But what I want to discuss is this is one of the favorites of the examiners. Charitable and other contributions. The rule here is whenever you donate, ang uso karon CSR. Okay? The the CSR, customer relations representative, no. What do you call what's the CSR? Um, Corporate social responsibility. That's CSR. Okay, so that's part of it. You just read this because there's a rule here. Upon recommendation of the commissioner, no part of net income of which inures to the benefit of any private stockholder or individual in an amount not in excess of 10% in the case of an individual and 5%. There's a lot of typos in the BIR webmaster. In the case of a corporation of the taxpayers, taxable income derived from trade, etc., etc. So there are contributions deductible in full whenever you donate to the government, donations to certain foreign institutions or international organizations, donations to accredited non-government organizations. You just take note of this word accredited. The NGOs, okay, you read this. And valuation, this, just read that. And proof of deductions. And remember, okay, this is different from the, well, because this is considered as a gift, right? This should be donation, okay? So donor's tax, but because this could be, you can claim deductions for that, for charitable and other contributions, okay? And you have this research and development, you just read this. And what's the other one? Pension trusts, allowable deductions for pensions in the trust. An employer establishing or maintaining a pension trust to provide for the payment of reasonable pensions to its employees shall be allowed as a deduction in addition to the contributions to such trust. You can do this. You can claim for a deduction if you have pension trusts. And paragraph K, okay, I've already discussed this earlier. And, of course, the optional standard deduction. This is different because, okay, this OSD, previously only individuals are allowed to claim for this, but this was amended and corporations can now avail of this. It's 40%. Now, whenever you claim OSD, you are not anymore allowed to claim for the itemized deductions. What is that? What are those itemized deductions? Well, the expenses. This one, the enumerated ones. So this is the alternative form, and you don't have to substantiate the expenses. You just get the 40% of the what? Gross sales or gross receipts, as the case may be. In the case of corporation, 27 and 28, okay, it may elect a standard deduction in the amount not exceeding 40% of its gross income. So this is 40%. Okay, that's standard, optional standard deduction. And premium payments on health and or hospitalization insurance for of an individual taxpayer, that's 2,400 per family. So the HMOs, okay, you can claim for that. And well, that's about it for the remaining lesser provisions. It just got you bored, right? But at least I guided you through it. And you just remember the charitable donations or charitable and other contributions. And this one, the taxes, because this was asked. And paragraph K, because this is the practice. I mean, it's real life. Paragraph K, as I okay, I will repeat that. The discussion on paragraph K, just to fill in the 20 minutes. We've already exceeded the 10-minute limit. Additional requirements for deductibility of certain payments. Paragraph K says any amount paid or payable which is otherwise deductible from or taken into account in computing gross income or for which depreciation or amortization may be allowed under this section shall be allowed as a deduction only if it is shown that the tax required to be deducted and withheld therefrom has been paid to the Bureau of Internal Revenue in accordance with this section 58 and 81 of this code. As I discussed earlier, you would be the expenses that you paid or that you incurred would not be allowed as a deduction if there is no showing that you as a withholding tax agent remitted that the tax portion of it to the BIR. There is this controversy, or a lot of companies are, well, including me. This is really, for me, it is kind of unreasonable because there is this memorandum circular issued by the BIR that even if you paid that already, paid to the Bureau of Internal Revenue, the well, the withholding tax, you remitted that, and they would still disallow that because of this provision, Section 58. It's a double whammy. As I've explained, what the gasoline station, the company purchased a like so much barrel of gasoline from the drums from the gasoline station, and it paid 1 million, and supposedly the withholding tax is 100,000. Ideally, the company would just issue a check for 900,000 and prepare a creditable withholding tax certificate for 100,000 to complete the 1 million, and the company would give that to the gasoline station. And if the company failed to do that, to prepare and remit the withholding tax, then that 1 million expense would be disallowed as it is not an allowable deduction. Okay, even if later on the company paid or remitted the 100,000, the BIR won't allow that. This is real life practice. So you should, whenever you encounter this, and well, if you become a lawyer, you advise your client to watch out for this provision. Okay, so next we will discuss about the allowance of personal exemption for individual taxpayer. Okay, that's it for section 34.